go. Welcome back to Jimmy at the Crossroads. I am Jimmy Sengenberger, your host for the program, day 3 of this show in partnership with the Washington Examiner. So great to be with you today. Yes, I love that tune because, well, of course, I'm playing harmonica in it, but also Biff Gore. He competed on The Voice, I think, season 6, got very far along the way. He is a pastor based out of Denver, Colorado, Highline Community Church. His voice is incredible. What he does in terms of creativity, you heard the rhythm there and the lyrics that he was singing out. Those were primarily written by Biff Gore in a 1-hour little session that we had, and then we went and recorded. It was so much fun. I've never done anything like that. And I do love playing the harmonica. I am so excited to have here on Jimmy at the Crossroads Phil Van Doorn, who's an investing columnist and analyst at MarketWatch, and became a good friend of mine, a good friend of my program, Business for Breakfast, when I hosted it on Denver's Money Talk back when it was a station here in town until late summer of 2019. And I wanted to get Phil's perspective on some things going on relative to the markets, investing, just overall things to keep in mind, and some of his recent stories. Phil Van Doorn, brother, are you there, my friend? We're getting the audio fixed up here. Stand by for just a moment. We're working on Phil Van Doorn here. Again, still working out some of the kinks here on Jimmy at the Crossroads. Nathan Matoush, by the way, our yeoman producer, being joined and supported by Corby Wise today. And I really appreciate both of these gentlemen doing some very good work. And while we're waiting, I do want to play, because I guess the volume was low. Let's do cut 6 on Dr. Fauci before and what he had to say, and make it so that you can hear a little bit better, because I think it's important to keep in mind just in terms of taking it seriously while not going overboard.
Is the worst yet to come, Dr. Fauci?
Yes, it is.
Can you elaborate?
Well, whenever you have an outbreak that you can start seeing community spread, which means by definition that you don't know what the index case is, and the way you can approach it is by contact tracing. When you have enough of that, then it becomes a situation where you're not going to be able to effectively and efficiently contain it. Whenever you look at the history of outbreaks, what you see now in an uncontained way, and although we are containing it in some
Jimmy,
respects,
can you hear me?
we keep getting people coming in from the country that are travel related. We've seen that in many of the states that are now involved. And then when you get community spread, it makes the challenge much greater. So I can say we will see more cases and things will get worse than they are right now. How much worse will get?
That's good. I think we got Phil Van Doorn there. Phil, I could hear you before. Are you there, my friend?
Yes, James, I am here. Can you hear me?
Phil Van Doorn, investing columnist and analyst. I can hear you. Thank you for, working our way through this. Really appreciate it, brother. How are you?
Great. It's good to be with you again. Having a miserable time in the markets, but otherwise, I think everything is just ducky.
Oh, no doubt. I'm glad everything else is just ducky. Hey, by the way, because you are a brother in the blues, we always commiserated on Business for Breakfast on the best bumper music known to man, a blues especially. What do you make of that theme song by yours truly with Biff Gore? And also Scott Mitchell doing a fantastic job on bass and drums and mixing and mastering that track.
I think it's fantastic. Your playing is amazing. His singing is excellent. I think you did it beautifully. And I really like the lyrics. I suppose you penned the lyrics, making sense out of nonsense. But that works very, very well.
I will give Biff credit for that. But it's so true. Like, he was channeling. We had a conversation. What is it that I'm trying to do here on Jimmy at the Crossroads? And he said, making sense out of nonsense. It's one of the things that came from his creative mind as a professional musician as Biff Gore is. And I love it.
Yeah, it's perfect. Also, I wonder who did the voice for Dr. Evil, because that worked quite well.
So that is Jimmy Viles. Jimmy with an IE is also the announcer at the start of the show. Somebody I've always enjoyed working with for years. You can see him there. He's if you switch over for a second, I don't know if that's showing because there's volume, but he was also Santa Claus in that video.
My own ugly face, and I see you, but not him. There he is. All right.
Yes, there you go. So that is Jimmy with an IE. And yeah, he is fantastic. And we're going to be seeing a lot more from IE here on Jimmy at the Crossroads when we do these little video breaks. So it's always fun stuff. But the market's not so fun right now, Phil. The market's not so fun.
No,
what do you make of it?
Well, you had Warren Buffett say that in his 89 years he had never seen such a double whammy. We already had the well, now it looks like it was a slow burn for a while with the spread of the coronavirus and all the supply chain worries. But then the Saudi government really let the ball drop, ostensibly feuding with Russia over disagreement over a plan to do the traditional production cut to try to prop up the price. The problem is the shale revolution in the United States has changed the world oil market so that the usual cuts by OPEC no longer prop up the price. Then, since Russia would rather let Saudi Arabia bear the burden of the production cut while they try to do what they can to prop up the price, the Saudis reacted by flooding the market. We'll see what happens. They tried this before with the cooperation of Russia in an attempt to bury the U.S. shale industry, and the result was humiliation for both. We'll see what happens this time, but my feeling is that you will see bankruptcies among the smaller shale operators in the United States, but other companies will pick up the pieces. Companies that can operate more efficiently, maintain positive cash flow over the long term, and work those same shale basins and keep the U.S. as the world's largest energy producer.
Again, Phil Van Doorn, our guest, investing columnist and analyst at MarketWatch. Okay, so in terms of some of the other sectors from a stock market standpoint, what are you noticing as being some of those that are particularly hit hard right now?
All of them are hit hard. I did a story recently about banks, highlighting the ones with the most exposure to oil and gas lending. So that was a list that came from KBW, which is a very strong shop when it comes to equity analysis for banks. And they listed a whole bunch of smaller regional banks that have a lot on the line with high ratios of energy credits to capital. Some banks can get wiped out from this depending on what happens. Some banks will be forced to sell. The largest banks can easily, like when we talk about JP Morgan, Bank of America, Citigroup, Wells Fargo, they have pretty considerable exposure. JP Morgan, for example, from its own annual report, if you divide total exposure to oil and gas by their tangible common equity, it's 22%. Tangible common equity is a conservative measure of a bank's capital adequacy, and it's something that regulators look at this time each year when they stress test the banks and decide how much they allow the banks to pay dividends, raise dividends, buy back shares, and deploy capital in other ways. So I believe this will keep the big banks from raising their dividends this year. That's a big deal. And then also they're going to face increasing non-performing loans. That's a big deal. So that sector is hit hard.
So in terms of the way people have been reacting, I mean, we've seen this market drop that has been certainly unlike anything I have watched. And it's stunning in a lot of ways, but I think that there are people who have been overreacting a little bit at this point. And I wonder if you think that's the case, if you agree with me, or if you think that people have been acting entirely rationally in terms of these drops of 7, 8, 9% that we've been seeing on a fairly regular basis now for all three major indices, Phil Van Doorn.
What's really going on is a little bit more complicated. I do not know any individual investors who are selling into this declining market. It's already too late. History has shown you're better off riding it out, especially if you're pouring money in every 2 weeks through a 401k plan, hopefully and sponsored by your employer. With all of that said, Benjamin Graham, who was Warren Buffett's mentor as a young investor, said you should expect a 33% decline or thereabouts in the stock market every 5 years. We have seen easily corrections of 10% almost every year. 20% is pretty common. Last I checked, which was 15 minutes ago, the S&P 500 was down 26% from its closing high on February 19th. So we're down 26%. Goldman Sachs analysts have predicted we may go down 28 to 30% from that peak before we start recovering later in the year. They think we'll only be down slightly for 2020. And if that turns out to be correct, when you average that with last year's amazing return, things may not look quite so bad. That said, energy is down 45%, the energy sector of the S&P 500 since February 19th. The industrials are down 30. The financials are down 34%. The best performing sector has been healthcare, down 18%. So you got to keep in mind, we had massive gains last year. We're giving a lot of it back this year and maybe more. And this is something you have to expect. As an investor, if you're in for the long term, it's going to happen again and again. We've learned this lesson before, but now the lesson is you can never predict what it's going to be. The virus was unpredictable. Saudi Arabia's game at this point was also unpredictable because the Saudis and the Russians.
We seem to have lost Phil Van Doorn right there, joining us from MarketWatch, investing columnist and analyst. We'll see what's going on there, if we can track him back. But I want to get to this point. He's touching on volatility a little bit here and what we've seen in some regards. And gosh, the volatility index, the VIX, the so-called fear gauge, is a measure of volatility. That is of institutional concern among investors that, you've got the ebb and flow in the market. And there was a period of time just a couple of years ago, where the VIX was very, very low. And it was single digits, in fact, and now we're at about 60. There we go. We got Phil Van Doorn. Yes, sir, we can, in fact, hear you. So I was just kind of using what you said before as a lead into talking a bit about the VIX, which is about 60 at this point. Yeah.
Forget the VIX. You have people who make side bets on the... Yes, you have people who make side bets on the VIX. It's one thing to be a day trader and buy a stock because you think it will go up or short it because you think that it will go down. But if you're betting on the VIX, you're simply betting on volatility itself. That's a crapshoot. So I would strongly encourage you not to encourage any novice investor to look at the VIX. People should be thinking long term unless they are day traders fixed on it all day.
Thank you. I'm so glad. And I knew you were going to go there, but at the same time, people look at it as some sort of a metric. So you're saying even though it's at 60, like that's just...
Non-professionals are looking at it now because media types keep mentioning it because they want something to talk about. But I really, really believe that volatility itself should not be the focus. We have very serious problems right now.
I hope everybody watching can see...
Volatility means up and down movement. It doesn't mean we're going down.
Well, sorry. I was just saying, I hope everybody can see why I like having you on the show, Phil Van Doorn, because you will tell it exactly as you think, and you're not going to sugarcoat anything. The VIX, to hell with the VIX. Nobody cares about that. And I think you raise such a very important point, actually, and I say this as someone who, does a lot of financial media coverage, that there is too much of an emphasis. I only bring that up because it is striking to me that a couple years ago, we were talking single digits, and now we're talking higher double digits, which at least is enough to say, okay, we've got a volatile market, but then again, we are seeing the volatile market play out in real time in all three major indices. In that regard, the VIX really is irrelevant in and of itself in general. Here.
The market's down tremendously over a period of less than a month, so we don't need the VIX to tell us we are in a period of high volatility. We've seen a few relief rallies, big rallies. We may have one, who the heck knows? We may have one tomorrow. after such a crazy day today? I have no idea, but we cannot be surprised if that happens. All that said, it's best to think long term. If you are a novice investor, if you are not a professional day trader, and I am certainly not a professional, long term is the way to go. Once you get to the point where you can't think long term and you're trying to draw income, then you focus on income and safety. So there are different investors with different objectives. You have to know your objective, look in the mirror, and then decide if you're going to commit to stocks. Can you tolerate periodic 30 or 40% drops if in return you will average 10% annual returns over the long haul? Because that's what we've seen. This is terrible. It's a double whammy, and I don't know how bad it's going to get. But the market will recover. All previous predictions of Armageddon have been incorrect.
That's so true. Phil Van Doorn, again, our guest, investing columnist and analyst at MarketWatch. I'm curious, though, how much of this do you think this market decline has been based on reality, what is really happening economically, or just based on fear of what might happen, and also what we're seeing in the media about coronavirus and some of the hysteria that's being ginned up by media folks and also by politicians who aren't just taking it seriously, but maybe trying to emphasize it even more for political gain?
Before my technical problem earlier, I was trying to point out that I don't know any individuals who are selling into a down market. We all know that that's a really bad thing to be doing. But if you're running an index fund, you're forced to do so. And when you do so, the index fund manager is selling in proportion to the weighting of the S&P 500, if that's the index, and that's usually what it is.
What does that mean?
He's selling all sorts of good stuff. He's selling the good with the bad. Can you hear me?
Yes, I can.
All right.
I'm following you. It makes sense.
The index fund managers are forced to sell the good with the bad if only a small portion of their shareholders liquidate. They have to raise cash. They have to sell, and then that can snowball because other investors see that those names are being sold. What all this means is if you are looking for income and you look at the highest quality dividend payers, your yields have shot up tremendously over the last month for some of them. You may be looking at some excellent bargains relative to a month ago. There may have been stocks you couldn't touch a month ago because the yields were too low, the prices were too high. But now you're getting those opportunities, and we're probably tomorrow going to publish a list of those. So it's something to look forward to, and it's something to think of if you're a dividend stock lover.
Final question, and I mean, this really dovetails in with what we've been talking about, but what do you think is the biggest mistake sort of a casual investor, somebody who's not institutional, who's not very focused on these things, but a casual investor could make at this point in a bear market?
Reacting to the headlines. Unless you're putting cash to work by carefully scooping up depressed shares of companies that you are confident will perform very well over the next 10 years, don't react to the headlines. If you're already committed, let's say you're a 401k investor, you're putting money in every 2 weeks, your employer is matching some of that contribution, keep going. If you have a 20 or 30 year investment horizon, don't change your strategy because you're paying lower prices now. When the market recovers eventually, you will be much better off than you would have been if you had sold and tried to time your re-entrance into the market. You will be better off than you would have been if you stopped contributing because you will not be able to take advantage of those low prices. So very long-term investors, stay the course, stick with stocks. Longer-term, shorter-term investors who are looking for income are hopefully going to enjoy the continued flow of dividend payments as they wait for the recovery.
Great stuff. Phil Van Doorn, investing columnist and analyst at MarketWatch. Always good to talk with you, brother. Thanks so much for taking the time today to join us on Jimmy at the Crossroads and talk about this craziness we're seeing in the stock market.
Thanks, Big Jim, and great. Best of luck with the new show.
Thank you, my friend. Again, Phil Van Doorn. Check out his writings over at MarketWatch. He will be, guarantee you, a regular fixture here on Jimmy at the Crossroads. So great to be with you. All right.